First off, we're going to dive into the recent past year of the general recession search on Google Trends. If you see, I've got them pulled up here. This was right here. These two ticks were before all of the decisions started happening with the Fed and what they were going to do to tackle this giant inflation they were seeing rise, like the talks of having to increase rate hikes. And around here, you see that's when he actually made the statement and went public with, yeah, we're going to go ahead, and he laid out his plan, which I'll get to that. He's not really stuck to it. That's probably why you're also seeing this nice trend line here. But look at this, 1, 2, how many times we keep seeing this spike in search, which it just, if you draw a trend line, it goes up. Here's my thing, is why you've seen a dip, which you might have seen that quick inflation went down, not by much, but it did go down. And then now we're seeing it again as we're coming to the late year end forecast. And, since he's having to, again, realign what he wanted to do prior to the posting on the Fed of what he was going to actually do by his 25, 25, 50, 50, 75, he's changed it up a little bit. And it's pretty much for sure he's going to do 75 again. But with that in general, seeing this tick up, I almost think we're also seeing a decline, because I think people are finally getting the message. I think it's been out in the news a lot, which I'm going to touch base on that as well. I think they're finally understanding it and getting ready for it, maybe, or paying more attention to it. That's why you're not seeing that big increase. It's kind of already out there now. People know it and they're ready for it. And I mean, we just had recent reports from, is it Jamie Dixon from JP Morgan? He warns big time that 2023, pretty much with the Fed not being aggressive as much, he was more dovish in the beginning on making the decisions. Well, if you're too gentle, it's going to take a lot longer. They think they should have came harder on the rate hikes. Maybe a lot faster, knock it out of the water, which a lot of analysts did say, to go ahead and just get it going. Let's start knocking this down and then reset the self. Well, he did it a little more soft because he wants a smooth landing. I get it. But it's almost like now he's playing catch up. Now he wants to really throw him in there and start dropping it down, which we're really close to seeing how that's going to go. We have also, Bank of America just put out that with these rate hikes, and even though the labor market, all of it's strong, they are trending and they're going to see a dip below that. We could start seeing up to 200,000 jobs lost monthly, which this sounds like so much negativity. I don't want to be a bear here, but also the bear market did get put in to affect June, which I also think is a little late. Almost 6 months of downturn, but we already have proof too that there was already 2 negative cycles of GDP, which is usually a guaranteed high. We're in a recession, or we're going to, but with how strong the labor market was and wage growth, that kind of offsetted it. But just in general, if you want some good news here, even though a lot of this sounds negative, it's just I'm trying to get people ready for it. Good news is that if you look at the cycles, even since 1950s, you can see that the average recession is going to last from 10 to about 18 months. And I'm going to go ahead and, honestly, because you can see all the numbers, you're going to go with this recession was almost put in place, not on purpose, but with when you have a pandemic like this and it dips that fast and then boom, stimulus and all that money, and positivity goes up and catalyst just like crazy. Well, you're going to need to fall and reset it. So I don't believe this was, something that just is typical economic data. This is something that was kind of forced. So we got to force it back down. That's why I don't see this lasting 2 years. I see it starting, as you start seeing earnings coming too. If you don't, I'll be shocked. But if you're going to seeing earnings lost by, like I said, even Apple on NASDAQ or JP Morgan, these people that are on NASDAQ and S&P that are big numbers and big holders of this, if you start seeing them drop, that's going to bring it down, which in line brings out the stock market. But also, to touch on leaving that with only 10 months. I'm going to go ahead and go in the shorter spectrum that I don't see the 18-month recession. I see possibly 10 or shorter. If you do your research and look or follow my material here, you're going to see that this doesn't look like we should be holding that low for that long, because there is still a lot of positivity. There's still a lot of strength in the economy. So a little help just in general while this is going on to get prepared for it. You can see if you're going to redo or kind of like recalibrate your portfolio. I'm kind of heavier in the tech sector, and I've already started to look here ahead, and I'm hoping for this little end of the year rally, if we can get one, and maybe pop out and move portfolio more towards consumer staples, where you're going to want to have more of your money, still hold that cash back, and put that more towards things that people need every day. And like I said, every video, not a financial advisor, I just do this a lot. I've been doing it for 10 years. So I do find it helpful to, help guide a little bit, and you can take the information or take the guidance if you want to. But you'll see it falls in line with a lot of what most analysts say, trying to look at a positive outlook after, this recession. But yeah, if you found this useful, go ahead and like, subscribe, share it. But like I said, you can see it's coming. Don't ignore the signs. Don't ignore the warnings. A lot of times it's just for clicks. It's just, it's people getting their clicks. But when there's this much going on, you can see it in the background data that this is going to happen. Nobody knows how long exactly. But that's why we have numbers, we have data, we have research history. It's great. So like I said, look up your favorite consumer staples. I'm not going to put any names out there. There's multiple strong companies, even like Walmart still doing well. Target had a dip. I know that was bought back in. It's got a buy rating. There's stuff like that that's just more of a safe bet, and you don't go all in, obviously, but it's a place to move your money and portfolio so you're not just falling down with everyone else. I don't think we've seen the lows yet either, so I think we're still going to see that happening. So that's where it's to get out here before that end of the year. Wait till they claim the lows, which you can kind of feel it. Since we're already down more than 50% of the year, I feel like we're getting close, but we're not there yet. Like I said, there's still more to come with the rate hikes. And until we start seeing a more dovish Jay Powell, no. I'd move to consumer staples and get ready for, a recession in 2023. Small one, but a recession.